Welcome to Mutual Fund Family.
Log on to mutualfundfamily.com for more info.
Hi, I'm Shriram Ramanathan. I head fixed income investments for L&T Mutual Fund. Today's rate cut of 50 basis points by the RBI has definitely delighted the markets today for more than one reason. One, the cut itself at 50 basis points was more than what the market expected. Two, very little in the nature of hawkish commentary or signaling by the RBI. Three, the FPI limit or the foreign portfolio investor limit has been increased with a clear schedule and a timeline for over the next 2 to 3 years. And fourth, I think importantly, indicating that the RBI continues to remain quite accommodative going forward. Various reasons have been cited for this larger than expected rate cut in its policy document. Primarily amongst them, food inflation has been in check despite a poor monsoon, mainly due to the government supply side measures that have been extremely effective so far. Broad-based disinflation across various subcategories of inflation. Weak domestic demand given falling industrial capacity utilization. And fourthly, fiscal deficit in control despite some risk arising from the pay commission outgoes as and when they do over the next few years. But also along with this on the global front, an FOMC which has been on a pause mode is also one of the reasons cited. And lastly, commodity prices and the kind of collapse that we have seen across the board over the past 3 to 6 months. But to us, the two reasons that really stand out in terms of which explain RBI's aggressive rate cut. One of them is a statement that is there in this policy, which reads that investments is likely to respond more strongly if more certainty is there about the extent of monetary stimulus in the pipeline, even if transmission is slow. Now this to us marks a bit of a departure from the RBI's side, and it actually possibly shows a change in RBI's reaction function in the growth versus inflation debate that has been raging on in the media over the past few months. It also possibly signifies a closer alignment of the government and the RBI in terms of providing more growth stimulative measures to the economy. The other important variable that could have influenced RBI's decision is more on the global front. The kind of growth slowdown that we have seen across the developed world and in the emerging world, along with that, the kind of price collapse that you have seen in asset markets, be it equities, be it currencies, and also FOMC's decision to delay the rate hike recently, the Chinese slowdown, for example, and also the credit concerns that are gradually coming across the globe. I think all these together definitely suggest growth slowdown bias in RBI's assessment of the globe right now, and also a potentially a deflationary bias to translating into our domestic economy as well. To us, this last factor probably explains a good amount of the reason for the change in RBI stance and the more aggressive 50 basis point cut that they have gone ahead with. With this 50 basis point rate cut by the RBI, in total the RBI has cut rates by 125 basis points so far in this year. We believe a bulk of the monetary policy stimulus in the form of rate cuts is now behind us. And we expect the RBI to be on hold for the rest of this calendar year. The focus from the central bank side will be on ensuring that banks pass on most of this policy rate cuts into their base rates to ensure full transmission of policy rates into the economy. However, going into next year, if the ongoing global deflationary situation continues and commodities continue to remain in a structural downward cycle, an additional room to cut rates by possibly 25 to 50 basis points could open up. We do need to be mindful, however, that the bar is quite high for additional positive surprises on the inflation front, and the government also needs to continue doing its work on maintaining the supply side situation in good control so that food inflation does not get out of hand. All markets, namely fixed income, equity, and currency, have reacted positively to this move by the RBI. as far as the bond market is concerned, while interest rates have moved lower across the board, the extent of fall has been quite different in different segments. While the money market curve, namely the 2 to 6 month part of the bank CD curve, levels have come lower by about 35 to 45 basis points, the short to longer end of the curve, which is basically the 1 year to the 10 year and beyond part of the interest rate curve, yields have come lower by about 10 to 20 basis points. Given this relatively muted reaction of the short to longer end of the yield curve to this rate cut, we believe markets have more room to move lower in terms of yields over the next few months. It could provide an attractive investment opportunity for investors to benefit as rates continue to move lower over the next 3 to 6 months. The other significant move by the RBI in this policy has been raising the foreign portfolio investor limit in our bond markets. This has been done in two ways. One, for the central government bonds, a timeline has been provided where a scheduled gradual increase in the FPI limit over the next 2.5 years has been laid out. This takes the total additional limit available to foreign investors by another 1.2 lakh crores. We already have the current limit is about 1.5 lakh crores, so this adds another 1.2 lakh crores over the next 2.5 years. Apart from this, state development loans, SDLs as they are called, has also been made eligible for foreign portfolio investors. This potentially adds another 50,000 crores of limit available to foreign investors to participate in our state government borrowing program. This is an extremely positive step over the medium term from an offshore investor's perspective, and this is likely to make India a bigger component of large global and emerging market debt funds over the next few years, which would hold India in good stead. According to me, from an investment strategy perspective, despite the 125 basis points cut in policy rates that we have seen since the beginning of this year, 10-year government bond yields have only moved lower by about 20 to 25 basis points since Jan. Similarly, despite today's 50 basis point rate cut, for example, the longer end yields have moved lower by only about 10 to 15 basis points. We do believe there is more room for rates to move lower to align with the current policy regime, and 10-year yields should move below 7.5% and possibly towards the 735 to 740 range over the next 3 to 6 months. This continues to make a strong case for some exposure of an investor's portfolio to long duration bond funds, where the portfolio manager's ability to add additional alpha can make 3-year cumulative returns quite attractive over a period of time. Similarly, spreads between certain categories have also become quite attractive. For example, spreads between short-end money market rates and the 1 to 2 year AAA bonds has widened quite significantly, and this, we believe, has a potential to compress over the next few months. Such compression should benefit funds such as ultra short-term funds and short-term funds, which are predominantly invested in high-quality assets in these maturity segments. Similarly, spreads between non-AAA and AAA securities have also widened significantly. Spreads on credit-oriented accrual funds are now closer to 250 to 300 basis points over similar maturity high-quality funds, and this makes the case much stronger than in the past to invest in judiciously managed funds in this category. All said and done, we believe fixed income funds are still likely to perform well over the coming few years, till there is meaningful signs of significant growth pickup in the economy. Investors need to be diversified not just in terms of fund houses, but also across some of the above mentioned categories, so as to keep risks moderate while still enjoying the move lower in interest rates.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Thanks for watching. Drop a like, leave a comment, and don't forget to subscribe Mutual Fund family.